Welcome to the lecture for Chapter 3, which deals with the time value of money. It's a very important concept. I'm going to try to get through it in one straight shot rather than breaking this up into multiple lectures, which I think I can do because there are some portions of the textbook that I think take a bit of a detour that I'm going to try to explain in a more straightforward way in this lecture, and I'll mention that as I come to it. So the reason that this is very important is that most of the decisions that we make about investments, about buying new machinery, buying a new truck for the company, buying a new location, investing and launching a new product, all of those kinds of major decisions, of course, they have financial ramifications. There's expenses that outlays of cash that we have to make in the hope of future benefits, either reduced expenses or cash inflows through revenue and that sort of thing. And most of those don't occur immediately. They occur over time. And so we'll get into how we properly analyze those so that we can make intelligent decisions about which is the right project to approve. So the definition of the opportunity cost of capital is it's the amount that's foregone, the interest that's foregone if you use the money for a different purpose. So as an example, I'll show on the next slide, if you invest $1,000 and you could get a 5% return, well, then the opportunity cost is that you're not going to get that return. So as I mentioned in the last slide, cash flows occur in different periods. Let's say we have an example where we can invest $10,000 in a machine, or a machine A, or $10,000 in machine B. And machine A is going to reduce our labor cost $1,000 a year for the next 10 years. And machine B is going to reduce our labor cost $2,000 a year for the next 5 years. So which one is the better one to choose? And so this kind of gets at how we make valid comparisons between those two opportunities. So it's going to involve cash flows over time. The key concept here is that a dollar today is worth more than a dollar in the future for a couple of different reasons. One is what I'll mention next here, this example, where if I take that dollar and I put it in the bank and I can earn 5%, well, I'm going to want to at least get that because I could have done that with no risk at all virtually. So part of it is foregone interest that I could have earned at the bank. And notice too that maybe I'm a company that has debt. Okay, so I could also take that money and I could pay down my debt and save interest. So saving interest and earning interest revenue are really equivalent in this perspective. The other is that there's risk. So there's a chance that things won't work out and I won't get my money. So interest rate and risks are tied to each other. So there is an interest-free rate of interest, which is usually the rate on long-term U.S. Treasury bonds. So that's considered the risk-free rate of return. And just about every other company that is borrowing money pays more interest than that because they're, even with very large companies, there is some risk of bankruptcy or those kinds of things. So that's one thing the book goes into quite an explanation about risk-free interest rates and risk premiums and all of that. And I want to kind of take that shortcut. So if we use the interest rate that is the company's cost of capital, it's going to include the risk related. And then there's also inflation, and the book also takes a detour about inflation, which I don't think is really super meaningful. So present value is the amount that we can bring back to today. So if I knew that I was going to receive $10,000 5 years from now, well, that's not worth $10,000 today. So I want to bring that back to today's dollars. So all future cash flows need to be brought back using present value techniques to today's dollars so that when I make comparisons, I'm comparing apples to apples. I'm comparing today's dollars to today's dollars. So you can see I can take the beginning of the year dollars and multiply by 1 plus my interest rate, and that'll give me the end of the year dollars. Well, I can also do it the other way around. I can take the end of the year dollars and divide by 1 plus the interest rate to get my beginning of the year dollars. So that's how I'll bring things back from a present value perspective. So some basic fundamentals. So some of the letters that we'll use here: FV equals future value. That's what is money going to be worth down the road as it compounds interest. And present value, PV, is what if I reverse that and bring those future dollars back to today's value. So R is going to be the interest rate. Usually it's an annual interest rate. And as I mentioned before, most companies use what their marginal cost of capital is. So if they had to go out and borrow money today, what would they pay to borrow that money? Or if they issued equity, what would they have to pay in the way of dividends, or some weighted average of the two if they do a mix? And then N is the period in years. So in this case here, the future value of a single flow of money is the present value times 1 plus R to the nth. So if it was $1,000 for 1 year at 5%, it would be $1,000 times 1.05 to the 1. So times 1.05, which would be $1,050. I could do it the other way around. For the present value of $1,050 that I've earned 5% on at the end of the first year, I could say 1,050 divided by 1.05 to the 1, and I would get $1,000. So the discount factor is 1 divided by 1 plus the interest rate, 0.05 in this case, to the number of periods. So you can do the math on your calculator, which is pretty straightforward. You can also use Excel. Excel has an FV function and a PV formula and a PV formula, so you can use that too. Or your book provides you with a table like this. So as we can see here, if we had 5% for one period, I go into the 5% column, the one period row, and I see 1.05. So I could multiply 1,000 times 1.05 and know that I'm going to have 1,050 at the end of that period. So let's first talk about what is the future value of a single amount of money. So not a flow of equal payments, but a single lump sum. So in this case here, this company wants to determine the future value of $50,000 that they invest for 5 years that compounds annually. That means you're going to earn interest on interest at a rate of 6%. So we could do this manually if we wanted to. So I could take 50,000 times 1.06. So at the end of the first year, I'll have $53,000. And I keep that money in this investment. So that 53,000 then grows by 6%. So at the end of the second year, now I've got 56,180. At the end of the third year, I can multiply again by 1.06. I get 59,551. At the end of the fourth year, 63,124, and at the end of year 5, I have 66,912. Well, that's a lot of math, and you could, if you had 20 years, that could take you some time to do. So the other way you could do it is you could either use that formula, so 50,000 times 1.06 to the fifth, okay, which is 50,000 times 1.33823. That gives me the same amount, 66,912. That's a faster way to do it. Or I could look up on the chart I just showed you and find the 6% column, 5 years, and I would find the factor for that, which I think is 1.338. So it's a little bit of rounding difference there. The formula, of course, gives you the exact number. So that's how I can find a future value. And that isn't so critical. That doesn't come up very often. What's more important is going the other direction. And I'll explain that in a minute here. So I mentioned this before, but it bears repeating because of how important it is. So all future cash flows have to be brought back to the present value. So we might be looking at multiple different kinds of investment opportunities in the company. If we want to try to rank them and say what has the kind of biggest bang for the buck, we want to bring that all back to today's dollars so that we're comparing all the projects on an apples to apples basis, right? Comparing today's dollars to today's dollars. So we can have two different types of flows, and we would look at both cash inflows and outflows. So money we receive and money we pay out. So we can have a single amount. So we pay $10,000 today, or I get $3,000 5 years from now. That's a single amount. or I could have a stream of receipts or payments, which are annuities. And again, we could treat them as single amounts and bring each one back individually. That's a little bit more time consuming. So there's also some factors we can use for that if it's a constant amount over a period of time. So the present value of a single flow, so this company wants to know what's the present value of 73,466 that's going to be received, it could be received or paid in 5 years. That's discounted at 8%. So that company's cost of capital is 8%. So you can see here the formula is a bit more complicated. 1 divided by 1.08 to the fifth, or I could look the number up in the chart and find that, okay? And that gives me $50,000 in today. So if somebody says they would give me $73,466 5 years from now, that's what I think I'm going to receive. That would be the equivalent to $50,000 today if I could invest or borrow money at 8%, if that's the correct discount rate. So let's keep in mind here, 8%, 5 years. So we look at the present value chart. That's in your book as well. And in this case, we've got, let's see, 6 years, 5%. Okay, so we can find the rate there. So the other thing I want to look at is a stream of money. So this company is receiving rental receipts of $6,000 each that are received at the end of each of the next 5 years, and we want to discount that stream of cash flows back at a 6% discount rate. That's their cost of capital. So the formula for that is a bit more complicated. I'm not showing it here, but I'm bringing each of those back individually, okay? So I could do that each one by itself, the present value for the different periods of time that each one is bringing it back for, or I could use the rate in the chart, which I can see here would get, it'd be 4.21236, so that would equal 25,274 in today's dollars. Notice I'm going to be receiving $30,000 over this period of time, 6,000 times 5, but that's not worth 30,000 in today's dollars. Okay, so I want to talk about how we combine these concepts into one type of analysis. So here's the chart that I just pulled the number from for that. So net present value, or NPV is the abbreviation for that, is a really powerful way to kind of combine different cash flows and look at what the net impact of that is. So the book talks about, so first of all, we look at the after-tax cash flows for each period. The book talks about taking into account the depreciation benefit we get from a tax standpoint. So I'm not going to include depreciation in the cash flows because I'm not writing a check for depreciation. But if I buy a machine and I depreciate it over a period of time, it is going to produce some tax savings. So I want to have those tax savings incorporated. So I can take the annual depreciation times the tax rate, and I could treat that as a cash flow, cash inflow, because it's a savings in future periods. So I would determine the discount rate, which I mentioned before is usually the marginal cost of capital. And then I would come up with the appropriate present value factor for each cash flow. So we would use 1 for today, and then everything in the future would be a number less than 1. And then I could sum all of those present values up to a net present value. So all of the different cash flows in present value terms, I can add them up. And if it's greater than 0, then it's a project that benefits the company and we should do it. If it's less than 0, we should reject the project. So another term for net present value calculations are discounted cash flows, or DCF. Some companies call it that. So I want to give you a couple of examples, and then I'll talk about alternative methods and we'll kind of compare those. So in this simple example I made here, we are going to invest $10,000 today in a machine, and you can see I'm excluding the tax ramifications of depreciation. So I'm investing $10,000 today in a machine that's going to save me $2,000 in labor for the next 3 years, and then after that, $1,500 in labor for the 3 years after that. So I could treat that as two separate annuities, but just to keep it simple so you can see what's going on here, I'm present valuing each one of those bits of savings back to year 0, to today. So the 10,000 that is in cash outflow, I'm showing that as a negative amount. It's cash leaving my company, and that it's in today's dollars, so I don't have to do any calculation to that. So the savings at the end of year 1, $2,000, I'm discounting that back to year 0. So I found the rate 0.943 from the chart for 6% for 1 year. So that's the equivalent 2,000. Discounted at 6% is the equivalent to $1,886 in today's dollars. I do the same thing with the savings in year 2. You can see that's worth a little bit less in today's dollars. That makes sense. As I go further out, money is being discounted more because I could have done something else with it for a longer period of time. So I bring all of those back and then I add them up. So I've got a bunch of savings there that are all in today's dollars. And I've got the expense of the machine, $10,000, and you can see here that it has a net present value of negative 1,288. Even though I'm going to be getting, what is that, 4,500 plus 6, 10,500 in savings versus 10,000 for the machine, because it's out in the future, it doesn't have the same value as the 10,000 I'm putting out today. So in this case, we should say, no, this is not a good project to do if our cost of capital is 6%. In this example, we assume no salvage value. So now let's look at another example where there is a salvage value. So in this case, same machine, same kind of savings, but now at the end of the 6th year when we're done with this project, I can sell the machine for $3,000. So you see I added that last line there at the end of year 6 where I received $3,000 and I present value that back. Now it has a positive net present value of $827. So I could borrow money at 6% and do this and come out money ahead. So the company should accept this. So those of you that have studied bonds before, where you have interest payments that you receive either semi-annually or annually, and then you have a lump sum that comes back to you at the end of the bond. So bonds are priced using this exact same model, where they're present valuing all the interest annuities that are going to be received in the future, and then the lump sum at the very end brought back to today's dollars. So if you remember, bonds are sometimes issued at a premium or a discount. It's because of this process that an investor would come up with a price they'd be willing to pay based on their expectation of an interest rate. So some things to be concerned about. So we want to make sure we deal with cash flows, not earnings. Accounting earnings include accruals and deferrals and adjustments that are made to kind of tell the story correctly, but it's really only cash that can be invested or spent, not earnings. So it's important to do it from an after-tax cash flow perspective. It's important to include any working capital requirements that a project might require. So there might be funds for inventory that have to be invested. If credit is granted to customers, there will be receivables that have to be funded. So there may be some additional money requirements for that, outflows. We would take into account opportunity cost, but not sunk cost. So a sunk cost is already been spent. We can't get it back regardless of the decision to go forward or not with a project. So that's not worth considering. But an opportunity cost, what if I, say in that last example, buying that $10,000 machine, if it meant that I was going to use some space in my factory that I was renting out to a neighboring company, well, now I'm foregoing that rent. So that's an additional cash outflow. So I'd want to take that into account. And then we would exclude financing costs because that's already built into the discount rate. So there are some alternative methods that sometimes companies use. So there are 4 different methods and they fall into 2 categories. So methods that consider the time value of money, which are, I think, obviously preferable. One is the one we just talked about, and then I'll also show you the internal rate of return. And then there are methods that don't consider the time value of money, which is payback method and accounting rate of return on investment, or ROI. So the first one is the simplest, which is payback. And that's just how long will it take before I earn back all of the money that I've made in my investment? So it's stated in a period of time. So in that example with the machine I used before, where the excluding the salvage value example, we'd earn our money back in the fifth year. So, or in the sixth year rather, we would earn that $10,000 back at that point. So we would say maybe that had a 5.5-year payback period. So it's a simple method. It doesn't take much brain power to figure it out. So you can also explain it to people easily. The problem is that it ignores the time value of money. So money, again, out further is worth less than money today. So it ignores that, which is a problem. And then it ignores what happens beyond the end of the payback period. So if I'm comparing two projects that have the same payback period, but one keeps saving me money and the other doesn't, well, this would ignore that. I work for a company that used this method as kind of their initial go, no-go on something. So they would not look at any investment that had a payback period that was less than, or that was greater than 3 years. So you had to first show kind of in a crude way that your project paid itself back within 3 years. And then if it met that criteria, then they would do the net present value calculations on it. So it's worthwhile for that purpose, I guess. The other way is accounting rate of return. So in this case here, we take the kind of almost like an income statement for the project, okay, revenues and expenses associated with a particular project over the average annual investment, and that's going to tell us what the rate of return is. Again, it's simple. You can use money or information that you already have from financial statements, so that makes it a little bit easier. Again, the problem is it ignores the time value of money, so you end up treating projects that have large cash flows at the end of the period the same as projects that have large cash flows at the beginning of the period, which doesn't make sense. And then again, accounting income and cash flow are really not the same thing. So the alternative for internal rate of return, this is both this and net present value are used very frequently. This is a little bit trickier from a math standpoint. The definition of it is it's you determine the internal rate of return, or the discount rate, the interest rate that causes all future cash inflows, I'm lacking a word there, I apologize, cash inflows to equal cash outflows. So you have to do this by trial and error to come up with the interest rate that causes the two to be equal to each other. And if that internal rate of return is greater than your cost of capital, then you do the project. If it's less than your cost of capital, then you don't do the project. So it's good in that it considers the time value of money. So it is doing the present value calculations. It's a more difficult method to use, and it gives you kind of the relative rate of return versus the magnitude of the benefit. So between these two, my preference is the net present value, or discounted future cash flows, but this is a method that you may come across in the real world as well. And there is a function in Excel for doing this as well. So that will end the lecture for this. I will probably tomorrow post a video of one of these problems as well. Thank you very much.